Hi everyone, welcome back to Be Rich. It's me Vinod here. A lot of you are wondering last video why was I looking down, looking here like this, like that. That's because I'm sitting on a higher chair. The table is much lower. I've asked the team to jerry rig it, so next video hopefully the table will come up. So you'll see the table in front of me. Since I'm sitting on a higher stool and Rupesh likes me zoomed in, you're seeing me hanging around like a ghost. So if you're wondering why I'm looking down, because all my notes are down here. So that's the reason it's like this. Hopefully, sooner or later, this will get sorted, and then you'll see the table and all the other paraphernalia in front of me, and you won't think, why is Vinod like looking down like a god upon the mere mortals down? It's not. It's just my notes which I'm looking at. Yesterday, I saw one of the comments which had come about a video which I did with Dana about the ETFs, and supposedly in that, one of you were upset that a few months back we were saying it's okay to buy IT ETF, and in that specific video I said you can avoid IT ETF in that video. ETFs and mutual funds I wanted to talk about this video. Sorry, I forgot to put on my mic. Page has acknowledged this, so now I'm wearing my mic. And I wanted to talk about ETFs and mutual funds, comparing it, and also explain why ETFs, you should treat it like stock. Because stocks, we pay attention to what's happening in the market, we pay attention to valuations, we pay attention to geopolitical, macroeconomic, all those things before we look into a stock. Same is true for an ETF and mutual funds. They're not impervious to all this news. They're also affected by it because a mutual fund, an ETF, is nothing but a sum of stocks. In the market, there is only one security, that is stocks. Of course, bond, that's debt, separate. But in a stock market, generally speaking, when we're talking about equity, there is only one security, which is the stocks. And ETF is a combination of that. So are mutual funds. So if they're a combination of stocks, and stocks follow volatility, and they are dependent on macroeconomic news and what is happening around the country, of course, ETFs and mutual funds will also follow suit. So keep that in mind when I'm talking about ETFs and mutual funds. Because when I was talking about mutual funds, ETFs, IT, a few months back and said, yes, you can definitely consider it to Dana. Then last video I told him, don't do it, is because the situation for the IT sector as a whole has changed. Thanks to Donald Trump coming into power, all the tariffs he's doing, and all the smash and grab which is happening with Elon Musk and him in the US, the situation for our IT industry in India is not so great. And till we get clarity, it is better to wait and watch, because opportunity might come in the not so distant future where they come into better valuations thanks to all the meddling from Musk and Trump. But should you look at it in the long term, or am I only talking short term? Whatever that happens is all short term. Trump's presidency is only for 4 years. These IT companies are huge. They will grow and evolve. And even with the AI disruption, they will evolve and grow. Like Sir Chandrasekhar spoke in a forum in Mumbai. He spoke about creating our own native AI. I'm sure Indian companies will slowly catch up. I know China has beaten us to the punch. US is there ahead, and then China followed suit with DeepSeek and Kimi and whatnot. India is still yet to launch something ingrown, homegrown, but I'm sure we are. There are things happening on the pipeline, I'm sure. We may not be used to having news on everything and which is available. It is nice if our government does do more allocation of funds towards this and offers more incentivizing this whole thing, like what Sir Chandrasekhar was saying. But I'm sure eventually we will also catch up to it, because end of the day, even our IT companies would like to make more money, and they will figure this out. But in the short term, there's going to be a lot of disruption thanks to AI, thanks to Trump, thanks to Musk, and it's going to affect the profitability of these companies. And there's already been a lot of price correction in a lot of these companies, and you may see more of it. So based on all that, so Anand said it's better to wait and watch as far as the IT sector is concerned. So this is what ETF is about. So ETF is nothing but some of the stocks in the IT sector, some of the companies which are considered very important to the sector. Those companies are listed into like an IT index, and the ETF is revolving around that index and is passively invested into that. So that is the reason why we're looking at it, and that's the reason why I said what I said. I hope that gave some clarity. Now talking about ETFs and mutual funds in comparison. So a lot of you are confused about ETFs and mutual funds. Are they the same? Are they not the same? What is the main difference between ETF and mutual funds when you're looking at investing? Especially the lot of you who are new to the channel or new to investing, who are confused about ETFs and mutual funds. I thought I'd clarify this, since I wanted to clarify about the IT ETF. Management, how these ETFs are managed or mutual funds are managed. ETFs are usually managed passively, meaning there's a list of stocks in the index. You are investing into those, or there's a list of stocks sectorially, like pharma, IT, which are defined. These are the companies and they're invested passively. They do not change at all. And unless the index changes, then like how Zomato was bought back into the index, not bought back, was brought freshly into the index. Then the index stocks change. So they're all based on a list and there's no real manager required for it. Based on that list, we keep investing. While in mutual funds, it can be passive like this, or it can be active. It could be a Vinod fund. I'm your fund manager, Vinod fund manager, and you give me money and I'll decide, based on my investing strategy, what my philosophy is, what my principles are. I might buy and sell for you, like your fund manager, and control how this is done. And for that, I charge a fee. And that fee is usually much higher compared to a passive fund. That is because of the difference in fee is the main reason why when you see compounding over a period of more than 5 years, if you go to 10 years, passive fund always wins, because that small difference, thanks to the fee, makes such a huge difference in returns over the long run. So even if I have an active fund, which is copying a passive fund, but the mere fact I'm drawing a little bit out extra as terms of fees can affect the returns in the long term. That is the problem with active and passive funds. That's why Anand says if you're investing for the long term, look passive. If you're planning to do something short term, you can look active, but though we discourage it because we are value investors and our horizons are always long, I'm sure there are people who are in other platforms who will encourage you to look at active funds for short term. For short term, I always prefer bonds and I prefer gold. So does Anand, and that's the way we see it. As far as buying and selling of ETFs, it is done the same as a stock, which is during the market hours. When the market is open, you can buy and sell ETFs. Today, for example, I invested into gold. I decided, looking at my portfolio, I was very heavily leaning on all equities. I didn't have enough gold with me. So I decided today I might as well buy some gold. So my today's tiffin coffee range, I spent it on gold, and that's gold ETF. I could buy it directly in the market, called Nippon B is what I buy. You can buy Tata Gold. What are the many ETFs? Gold ETFs. You can pick and choose which whenever you like. So you can buy it actively during the market hours. It's actively traded. Mutual funds is not done like that. You cannot go buy a mutual fund unit, NAV as it's called, during trading hours. You have to wait till the market day is closed. Then you can buy and sell your mutual fund units. Pricing. As far as pricing is concerned, ETFs move intraday. That means they move volatility of the ETF is completely based on the stock market. So during the day, it can go up. So today, let's say gold opened at 70. End of the day, it might close at 72 or might close at 68. It moves through the whole day. It goes up and down. That's called intraday, and it's based on demand and supply, just as any stock is. Meanwhile, in mutual funds, the price is set at the once a day, and it's called the NAV, which is a net asset value, which is the cost of a unit, and that is set once a day, and that's the price for the mutual fund for that day. Expense ratio, like I said, passive funds have much lower, so ETFs are passively managed, so their expenses are much lower than negligible compared to mutual fund active funds, which are much higher. What if you want to compare apples to apples, will be a passive mutual fund, and if you compare a ETF, that will be more closer to comparing apples to apples in terms of returns. Minimum amount, ETFs have no minimum amount. You can buy just one share, like how you buy one share of ITC, you can buy one Nippon B's for 70 rupees today or 72 rupees, whatever it is. But mutual funds are not like that. Some of them have minimum amount. The NAV might be X amount, but they'll say the minimum amount you have to invest is 10,000 rupees. Minimum is 25,000 rupees. So that is, depending on the fund and how it is structured, they may have a minimum amount, entry amount. Liquidity, ETFs are highly liquid, meaning it's very easy to buy and sell, like gold ETFs. You can buy them every day and sell them every day. Mutual funds tend to be less liquid. You can sell them and buy them, but it takes a lot more time and you need to make a different way of selling it and buying it compared to ETFs. ETFs on a single day, in the morning I can buy it, end of the day if I want it, I can square it off. So there's different ways, though I don't suggest you do that. If you are investing in anything, I always hope that you are investing for the long term, unless there is some reason to sell, like I've said in many other videos. As far as taxation is concerned, ETF taxation is very simple. It's like a stock. Mutual fund taxations are slightly different. Capital gains, even ETFs have capital gains depending on how long you hold it, like stocks. But mutual funds taxation is slightly different. So it is best always to have an auditor or a financial consultant at least who can highlight how this taxation works, especially considering your salary or your current income, what taxes you're filing already based on your income tax. They can tell you how to go about doing this. And as far as risk is concerned, both are what you call risk is dependent on what happens in the market. As far as ETF is concerned, ETF's volatility is completely like the market volatility. When you see FIIs buying and selling and DIs buying and selling, all that volatility affects ETFs. But in the case of mutual funds, the ETF is completely dependent on, especially active funds, depends on the management of the fund. So the market might be doing very well, but if your mutual fund, active fund is poorly managed or mismanaged by a manager, it can deprive you of good returns. There is no guarantee that if the market is doing well, your active mutual fund will also do very well. Same way, there is no guarantee just because the market crashes, your active mutual fund will also crash. So it all depends on how it's managed. So the risks are different for mutual funds, but ETFs follows pretty much the market. So now the question comes, who's this ideal for? ETFs are cost effective for people who are cost conscious, who want every single rupee they put into the market working for them. I would say ETFs are the best bet. People are looking for, professionally managed because they do not understand the market, they do not understand dynamics, they do not know what stocks are, how to buy and sell. They would prefer foregoing a little bit of their money, but rather have someone who knows the things managing it for them. Then mutual funds can be something. You can look at active funds. I don't encourage it because I don't think it's very complicated, because mutual funds is nothing but picking a list of stocks, and you can find out whichever mutual fund you like, active fund. All that information is published. There's no secret recipe to it because the rules mandate such that the guy has to tell you publicly what all stocks and what weightages he's investing in. So you can look at it and you can pick those stocks up yourself. Of course, it's easier said than done. I can understand that. In the short term, active funds may always look like they're offering better return. But in the long term, like I said in the beginning of the video, ETFs and passive funds offer better return in the long term. So what is similarities between them? The great thing about both ETFs and mutual funds is it offers diversity baked into it. Meaning when you buy a single stock, you only have that single stock or business you're invested in. But when you invest in an ETF, you're invested in a group of stocks or a group of sectors. Same is true with a mutual fund. Instead of investing in one single stock like ITC, you're investing in a group of stocks. So it does help you lower your risk and stay diversified, which is a good thing when you're investing. So if you do not know about stocks, how to buy stocks, how to stay diversified, how to balance your portfolio, all this is going way over your head, then ETFs and mutual funds make sense to you. And ETFs are passively managed, so there's no professional management. But in the case of a mutual fund, you can have a professional management running your fund for you. So, and another thing is variety of choice. When you look at ETFs, you can be in multiple sectors, or you can look at the index ETF and you're invested in multiple companies in different ways and shapes. If you have a very limited fund pool, like Dana was saying, a lot of Gen Zs only have 1,000 rupees, 2,000 rupees to invest in a month. You can approach this as an opportunity to invest in a wider variety of stocks by investing in ETFs compared to buying single stocks. My argument would be counter to that. Would say that if you're like 23 years old and you have a long time horizon and you plan to be working for the next 25-30 odd years, it's a great opportunity to buy stocks individually, as they offer you much greater returns in the long term. Individual stocks, if you pick them right. Of course, it only works if you pick them right and not pick random stocks. So this is the main difference between ETFs and mutual funds. Like I said in the beginning of the video, there's only one security in equity market which is traded, which is what the market is based on, which is a stock. ETFs and mutual funds are nothing but combinations of stocks. So whatever stock is, affects a stock, such as news, foreign institutional investors, domestic investors, market news, all that affects the stock price. Same way, all those affect the ETF and mutual funds. And the main reason I said right now, IT, you can wait the ETF is because IT sector as a whole, we are in a wait and watch mode. So the ETF is part of the IT sector. So that is the reason why we're saying wait and watch. Nothing wrong with the IT sector. It's just that there might be some short-term pain and there might be some volatility in the price that's going to come in because of that. So we better wait and watch to see what happens and how it unfolds before we decide to put in capital. Maybe we can put capital elsewhere, which will give us better returns for the long term right now than the IT sector. This is advice which I wanted to share with you. I hope you found this video informative and entertaining. I hope you did manage to get some investing done today. Like I said, I did some gold, so I hope you did something. I wish you a wonderful evening as always. I'll see you tomorrow on the last day of the week as we round up the week, and I'll kind of cover what all happened from Monday to Friday and maybe give you an outlay of what's going to happen the following week and what you should keep an eye on. Thanks for watching the video as always. Always enjoy your company here. Thanks for watching Be Rich Today.